A very good evening to all the participants of this webinar from DTRTI Lucknow. I'm Arvind Mishra, Deputy Director, welcoming you to part 3 of depreciation accounting today. I hope that my voice is clear to you all and my video is also visible to you all. Friends, today in this session, we are dealing with other methods of depreciation accounting. So the method that we will start with today is the sinking fund method. Now, if a large sum of money is required for replacement of any property or any plant or equipment at the end of its effective life, when some property, plant or equipment has completed its useful life, and after it's having completed its useful life, if we are supposed to replace that thing with a new one, it may not be very advisable to leave the amount of depreciation set about annually, for it may or may not be available in the form of the readily realizable assets to the enterprise at the time it is required. So if we set apart some amount of depreciation annually, either by creating a reserve or by creating some provision, it is possible that that reserve may not be available to us in a readily realizable form, so that when the time comes to replace the property, plant or equipment, we are not having any liquid assets or liquidity, or rather cash, with which to buy a new property, plant or equipment. So therefore, just setting apart certain amount for the certain amount of depreciation annually may not help us to replace our asset which has lost its utility anymore. So therefore, to safeguard this position, instead of annually providing for depreciation, which is perhaps credited to the provision account by debiting the depreciation account, instead of doing that, the best method, or a better method rather, is to place to the credit of a sinking fund account certain amount, and at the same time an equivalent amount which is equal to the amount set apart in the sinking fund account would be invested in the government securities. And you are well aware that government securities can be liquefied anytime. So instead of crediting the provision account where we are setting apart the depreciation, we are creating here a sinking fund account, and we are crediting the amount annually into the sinking fund account, and the same amount which we are crediting to the sinking fund account, an equivalent amount of that we are investing in government securities. So in other words, whatever amount we are crediting to the sinking fund account, the same amount we are investing in the government securities. Now, once these securities are invested, the interest that we received on these securities, whenever received, would be again reinvested, and that amount would also be credited to the sinking fund account. So we are investing an initial amount or an annual amount into the government securities. Whatever interest we are getting on those government securities, that also we are investing into the government securities and crediting to the sinking fund account. So thereby the sinking fund account will keep on growing, and at the same time our investment in the government securities would also keep on growing. Now the amount of the annual provision for depreciation in such a case has to be calculated. So for doing that calculation, after taking into account the interest that the amounts annually invested shall be earning over the period these will be invested. So when we calculate the annual provision for depreciation, we'll also take into account the interest that the sinking fund balance would earn, which is invested in the government securities. So then what happens is that when our asset is due for replacement, or when our property, plant or equipment is due for replacement, the securities are sold, because securities can be sold at any time, and the new asset is purchased with the proceeds of the sale of the government securities that we had purchased, with the equivalent amount of fund that we had credited into the sinking fund account. Now the book value of the old asset, which had lost its utility at the time, is transferred to the sinking fund account, because there will be some surplus value also of the old asset for which we can sell the old asset, which has lost its utility in the market, and get some salvage value or surplus value, and that surplus value or the book value of the old asset is also transferred to the sinking fund account. So any amount which is realized on the sale of that old asset, as well as along with the profit earned on the sale of securities, is transferred to the sinking fund account, and then the sinking fund account is closed off by transfer of the balance of the profit and loss account or the general reserve. So what we are doing in essence out here is that we are using the sinking fund amount, whatever proceeds are credited to the sinking fund account, we are using that to purchase the new asset, and whatever amount is left out, or we don't need that amount, we'll transfer that to the general reserve or to the profit and loss account. So the sinking fund account is basically serving the purpose of a readily available account, which is having enough funds, the equivalent of which are invested in government securities, and which will be used to buy the replacement asset for the old asset once the old asset loses its utility. Now, how much amount has to be set apart annually by way of depreciation is found out from the sinking fund tables. So there are certain sinking fund tables which have been prepared on the basis of mathematical formulae, and they help us to ascertain straight away how much amount we can set apart by way of depreciation. Now these sinking fund tables they show the amount that we must invest every year, so that we can accumulate to ₹1 at a given rate of interest within the stated period. So therefore, this ₹1 accumulation is the amount which we will need to replace the asset. We have to first decide how much amount we will need after, let's say, the useful life of the old asset is over. So for example, if the old asset life is for about 5 to 6 years, or let's say 6 years, or let's say 9 years, whatever it is, we have to estimate what will be the replacement cost of that asset after so many years, or 9 years. Sinking fund tables will tell us that if we needed ₹1 for replacement, how much depreciation we have to provide in this year. So therefore, if we multiply that ₹1 with the amount of replacement value that we need after 9 years, we can get the total amount of depreciation that we need to allow in our accounts every year. Now, what are the relevant journal entries to be made here. First of all, we transfer the depreciation to the sinking fund by debiting the depreciation account and crediting the sinking fund account. Then this depreciation that we have debited in the depreciation account, we credit that depreciation account with the same amount, and we debit the profit and loss account, by which we are transferring the depreciation into the profit and loss account. Now, for the purpose of investment of the amount of depreciation into the government securities, what we do is that we credit the bank account and we debit the sinking fund investment account. Because here we are transferring the money, the equivalent amount of money that is there in the sinking fund account, from the bank account to a sinking fund investment account, from which we will invest into the government securities. Now, subsequently, when the interest will be earned on the sinking fund investment and on the investment of the interest and the depreciation, we will be debiting our bank account with the interest earned and crediting the interest on the sinking fund investment account, and then again debiting the interest on the sinking fund investment account and crediting the sinking fund account. So thereby what is happening is that the interest that we are earning on the investment that we are making out of the sinking fund investment account, that interest is going into the bank account and getting credited to the interest account initially, and then that interest on sinking fund account is again debited and sinking fund account is credited. So thereby what we are saying is that the balance in the sinking fund account will go up by doing this, and by the value of the interest that we are earning, and therefore we will need more money to be transferred from the bank account to the sinking fund investment account. So what we will do now is that we'll transfer that money from the bank account to the sinking fund investment account, along with the yearly depreciation. So every year we are transferring from bank account to sinking fund investment account an amount equal to the depreciation plus the interest earned on the government securities. Now, what happens is that when the useful life of the old asset is over, we need the funds. So what we do is that from the sinking fund investment account, which has been invested in government securities, we sell the securities, and thereby we are crediting the sinking fund investment account and debiting the bank account, because the amount that we get on sale of the securities we are debiting to the bank account. So now we have amount in the bank which we will use to buy the asset. So if this sale that has happened of the government securities is at a profit, then we debit the sinking fund investment account and credit the sinking fund account, because whatever the additional amount of money or profit that we are getting while selling, that additional amount we are also transferring to the sinking fund account, and then again by transferring this additional amount in the sinking fund account, and therefore we will need to have more amount consequentially in the sinking fund investment account by transfer from the bank account. So thereby then what we do is that we debit the sinking fund account and we credit the asset account, because we are transferring the amount to the extent of the book value of the asset from the asset account to the sinking fund account. What we are doing here, the old asset has certain salvage value, so we sell that old asset, and so thereby we are transferring the book value of the old asset by crediting the asset account to the extent of the book value that we'll get by selling that asset and debiting the sinking fund account. So by doing this, the old asset is going out of the picture, and therefore an amount equal to the sinking fund, an amount equal to the book value of the asset is going out of the sinking fund account also. Finally, whatever surplus we are having in the sinking fund account that we are not going to use for buying the new asset will be transferring to either to the general reserve account, and if there is any deficit, that may be transferred to the profit and loss account as a loss. And why this sinking fund account surplus is being transferred to the general reserve? Because we don't need that amount in the sinking fund account, because that the utility of the sinking fund account is gone now, because we have already utilized the amount that we had invested for purchase of the asset, new asset. So for purchase of new asset, we don't need to write an entry here for the depreciation. Straight away that would be bank account credit and purchase of the asset, so debit new asset account. But in this entire process, if some surplus is remaining in sinking fund account, we are transferring that to the general reserve. On the other hand, if there is a deficit in the sinking fund account, that will debit to the profit and loss account as a loss. Now this method may also be operated a little differently, because the amount set apart on account of depreciation, instead of investing that annually in the purchase of government securities, that amount may be paid out as a premium on an insurance policy maturing at the end of the life of the asset. Here what we are doing is that we are, instead of buying government securities with which we can purchase a new asset once the useful life of the old asset is over, we are just buying an insurance of the asset, and what we are paying out is a premium on the insurance policy, and an insurance policy will mature at the end of the life of the old asset, so that by that time the old asset completes its useful life, our policy would have matured and we would have got the sum assured. Here an additional advantage is that something happens to our old asset, we get compensated for that also, because this is a insurance policy. So in case we are doing this, then the amount of premium whenever we are paying for the insurance policy, that will debit to the policy account instead of the investment account, because so far what we are doing is that we are debiting that amount to the investment account, the now sinking fund investment account. Instead of sinking fund investment account, now we will debit the amount to the policy account. Now, as an explanation of this, or for a deeper and a clearer understanding of this particular method of depreciation accounting, let us look at an illustration. Now let us say that on 1st of April 2013, there is a company called Z Limited. It has purchased a lease of property, and it has purchased the lease of property for 10 lakh rupees. Now this lease would expire on 31st March 2016. Therefore, it is a three-year lease, and for this 3-year lease, 10 lakh rupees investment is there. Now Z Limited decided that it will set up a sinking fund. So the sinking fund was to be credited with annual contribution from the profit. The interest on the investments and any profits which are made on the realization of the sinking fund investments, they will also go to replenishment of the sinking fund. So therefore, what we can say here is the sinking fund would be credited with the annual contribution from the profit being made by the company. There will be an annual contribution amount coming from the profit. In other words, a depreciation amount. There will be a contribution from the interest on the investment made, and there will be a contribution from the profits made on the realization of the sinking fund investments when the sinking fund investments are redeemed or sold. Now the sinking fund, it was decided that it will be represented by a specific investment, and any sums made available to the sinking fund were to be immediately invested in that specific investment. So a specific investment was decided upon that whatever amount is credited to the sinking fund account, that would be invested on a continuous basis. An equivalent amount will be invested in a specific investment, except at the termination of the fund, because at the termination of the fund, we don't need any specific investment. So during the 3 years of the lease of the property for 10 lakh rupees, the 3 years for which the lease was continuing, on 31st March 2014, that is after 1 year, a contribution from the profits of 3,20,000 was made, and this sum was invested in the specific investment. Then on 13th of October 2014, which is after about 6 months' time, and investments which originally had costed 1,10,000 rupees were sold for 1,20,000 rupees. So here a profit on the realization of investment is happening, and whatever proceeds were received, so there is a 10,000 rupees profit here. Whatever proceeds were received were reinvested in the specific investment. Thereafter, on 31st March of 2015, a contribution from profits of 3,20,000 was again made. So every year, contribution of 3,20,000 is being made, and the interest on investment of 16,000 was received, and this amount was also reinvested in the specific investment. Thereafter, on 9th of August 2015, investments which had originally costed 2,10,000 rupees were sold at a profit of 20,000. So that means they were sold for 2,30,000 rupees, and whatever proceeds of sale were received, they were reinvested in the specific investment. And thereafter, on 31st March 2016, the interest, because on 31st March 2016, we don't need to make any contribution from the profits because 3 years are over. Interest on investment 48,000 was received, and it was just received, and it need not be invested anymore. It was not invested. All the existing investments which were remaining at that time were sold for 6,60,000 rupees. Then the contribution from the profit of an amount required to make up the sinking fund to 10 lakh was made, because we want the sinking fund to go up to the level of 10 lakh rupees. And this amount was also not invested. Now, the sinking fund is raised to the level of 10 lakh here because maybe we want to buy a new lease of 10 lakh, because our initial lease was also 10 lakh. So therefore, we have to raise the level of sinking fund up to 10 lakh so that we can buy a new lease after 3 years. Now here we have to prepare the sinking fund and the sinking fund investment account for the years 2013-14, 14-15 and 15-16. So therefore, let us look at the sinking fund account. In the sinking fund account, what we are doing is that on 31st March of 2015, on 31st March of 2014, we are taking a contribution from the profit, and what we are doing is that we are crediting the sinking fund account with the contribution from profit of 3,20,000 rupees, and we are debiting the depreciation account by 3,20,000 rupees. So the journal entry out here is debit the depreciation account and credit the sinking fund account by 3,20,000 rupees, and this 3,20,000 rupees is thereafter carried down, and after being carried down, it is brought down on April 1, 2014. So 3,20,000 rupees brought down on April 1, 2014. Thereafter, we are making a profit on October 13 of 10,000 rupees, and that 10,000 rupees is also being invested, and therefore the entry out here is the credit to the sinking fund account and debit of the sinking fund investment account. Of 10,000 rupees. So 10,000 rupees is actually the amount of the profit. As we have seen on 13th October, we sold investments worth 1,10,000 rupees for 1,20,000 rupees. So thereby we are making a profit of 10,000 rupees here. This profit of 10,000 rupees that we are making by selling the investments, to that extent, that amount is being transferred to the sinking fund account so that we can make further investment in the sinking fund investment account. So thereby, the additional profit that is being generated in the sinking fund investment account is being transferred to the sinking fund account by crediting the sinking fund account and debiting the sinking fund investment account by 10,000 rupees. Then we are earning interest on the sinking fund account by March 31. So interest on sinking fund account has been earned of 16,000 rupees as per the illustration question, and this 16,000 rupees has to be again invested into the sinking fund account. So this is a interest on sinking fund investment account is being debited by 16,000, and sinking fund account is going to be credited with 16,000 rupees. Finally, at the end of the financial year, depreciation account is debited for 3,20,000 rupees, the annual contribution, and the sinking fund account is credited by 3,20,000 rupees. So taking all these things into consideration, now we have 6,66,000 rupees to be carried down, and that is brought down to the 1st April of the next year. Now after 1st April, on August 9, a profit is being made of 20,000 rupees on the sale of the investments in the sinking fund investment account. So this additional amount of 20,000 rupees, which is generated into the investment account by selling of certain properties, it is transferred to the sinking fund account by crediting the sinking fund account and debiting the sinking fund investment account to the extent of 20,000 rupees. This transfer of the additional profit that is being generated by sale of the specific investment that was made out of the sinking fund investment account. Thereafter, an interest which was earned, and it is now in the sinking fund investment account. It is being transferred to the sinking fund account of 48,000 rupees by crediting the sinking fund account for 48,000 rupees and debiting the interest on the sinking fund investment account, because right now the interest on sinking fund account stood credited with 48,000 rupees. We close the sinking fund interest on sinking fund investment account by debiting the interest on sinking fund account for 48,000 rupees, and in turn we are crediting the sinking fund account for 48,000 rupees. Having done that, we find that we have to take a new lease for 10 lakh rupees. So this new lease, for this new lease, we are debiting the sinking fund account with this 10 lakh rupees and crediting the lease account. with 10 lakh rupees. Now, having done all this, we realize that we need a certain amount of depreciation, because we need to debit certain amount to the depreciation account for contribution for coming from the profits for the purpose of depreciation. So to calculate the depreciation amount that is required, we just need a balancing figure in the sinking fund account. So the balancing figure is taken by subtracting the left side and the right side of the sinking fund account, and when we do that, we find that a balancing figure of rupees 2,92,000 rupees is required here. So finally, we also know that in the sinking fund investment account, we have 26,000 rupees, and therefore we debit the sinking fund account and credit the sinking fund investment account with this 26,000 rupees. And finally, we get a balancing figure of 2,92,000 rupees for depreciation for the last year. So the last year depreciation amount is not 3,20,000 rupees, because whatever is needed, we'll be taking that much only. So therefore, instead of taking 3,20,000 rupees, we just take a balancing figure, that is whatever amount is required to make our sinking fund total to come to 10 lakh rupees, we are doing that only. So the contribution from profit of an amount which is just required to make up the sinking fund to 10 lakh, that amount is utilized here. Now, if we look at the sinking fund investment account, what we are seeing out here is that on 2014 31st March, what we are doing is we are debiting the sinking fund investment account and crediting the bank account. So thereby we are transferring this 3,20,000 rupees from the bank account into the sinking fund investment account and making a specific investment here. Why we are making this specific investment? Because this is equal to the amount that we transferred from the profits to the sinking fund account. Now the sinking fund account, we mentioned that sinking fund account is on the liability side of the balance sheet, and the sinking fund investment account is on the asset side of the balance sheet. So we are debiting the sinking fund investment account and crediting the bank account with 3,20,000 rupees on 31st March of 2014. Then this amount is carried forward to the 1st of April of 2014. Thereafter, we make a sale of 1,20,000 rupees of securities or specific investments that was actually worth 1,10,000 rupees. So when we make that sale, we get 1,20,000 rupees into our bank account. When we get this 1,20,000 rupees into our bank account, what we do is that we credit the sinking fund investment account. So this 1,20,000 rupees going out of the sinking fund investment account and moving into the bank account, because we are crediting the sinking fund investment account, debiting bank account with the sale of the specific investment of 1,20,000 rupees. This investment was originally worth 1,10,000 rupees, but was sold for 1,20,000 rupees. So here a profit of 10,000 rupees is made. So when a profit of 10,000 rupees is made, the sinking fund investment account is debited with this amount of profit on sale by this 10,000 rupees, and the sinking fund account is in turn credited with this amount, because we are transferring the profit on the sale from the sinking fund investment account into the sinking fund account, because this is additional profit that has been generated within the sinking fund investment account. We don't want it there. What we do is that we transfer it from the sinking fund investment account to the sinking fund account. So any profit on sale, which is equal to 10,000 rupees, because the original investment was worth 1,10,000 rupees. It was sold for 1,20,000 rupees. So a profit of 10,000 rupees, additional profit of 10,000 rupees was generated here. This additional profit of 10,000 rupees need not be kept here. So what we do is that we transfer that amount to the sinking fund account. Now on October 13th itself, what we are now doing is that we have to invest the sale proceeds once again. So when we invest the sale proceeds once again, we credit the sinking fund investment account and we debit the bank account. We are debiting the bank account and crediting the sinking fund investment account by investing the sale proceeds of 1,20,000 rupees that we had received earlier. Because what had happened was that when we received the sale proceeds, we had credited the sinking fund investment account and debited the bank account. Now we have debited the bank account. So now we have to reinvest these proceeds back into the sinking fund investment account. So we again debit the sinking fund investment account, credit the bank account. So we are transferring this amount from bank account to the sinking fund investment account again for reinvestment into specific investments. Now again, on 31st March 2015, we are transferring a depreciation amount, a fresh depreciation amount is 3,20,000 rupees and 16,000 rupees more. So we are making investment of depreciation amount plus interest. Interest is 16,000, 320 is the depreciation. So depreciation plus interest, that amount we are debiting to the sinking fund investment account and crediting to the bank account, thereby transferring this amount which is equal to the depreciation plus interest earned. So we are in essence we are reinvesting the interest and the depreciation amount. We are investing the depreciation and reinvesting the interest amount by transferring from the bank account to the sinking fund investment account, so that out of that amount we can make a investment into a specific investment. So having done that, we are left with a figure of 6,60,000, and that we are carrying down, and then later on that the 6,60,000 rupees we are bringing down on or bringing forward on April 12, 2015. Now on August 9 of 2015, as we have seen that we are selling investment worth 2,10,000 rupees for 2,30,000 rupees. So this 2,30,000 rupees will be credited to the sinking fund investment account and debited to the bank account, because this money is flowing into the bank account. We have made a profit of 20,000 rupees in this transaction, and therefore profit on sale is reinvested by debiting the sinking fund investment account and crediting the sinking fund account. And there is a loss on the final sale, and that is 26,000 rupees. And of course, we are transferring an amount in the bank account also. So on 31st March 2016, we are making this entry that we are, first of all, on August 9, we are investing the sale proceeds, because these 2,30,000 rupees that we have received, we have to invest back, because we have invested it again by debiting the sinking fund investment account and crediting the bank account, thereby transferring this amount of 2,30,000 rupees back into the sinking fund investment account. Now, having done that, we realized that we have made a loss on the sale of 26,000 rupees. So if we had made a profit on the sale, we would have debited the sinking fund investment account with it. But since we have made a loss on the sale, we are crediting the sinking fund investment account with 26,000 rupees. And finally, whatever is remaining is 6,60,000 rupees. We are transferring back to the bank account. So this is a balancing figure. 6,60,000 rupees is being transferred back to the bank account because we don't need the sinking fund investment account anymore. For the sinking fund investment account was basically meant to make specific investments, and once the specific investments have lost their utility, we don't need any further investments, and therefore sinking fund investment account is closed by transferring the balance of 6,60,000 rupees back to the bank account. So here the sinking fund investment account is credited and the bank account is debited, thereby transferring the balance of the sinking fund investment account back to the bank account. So all the existing investments were sold for 6,60,000 rupees, and thereby, as the investments were sold for 6,60,000 rupees, we got 6,60,000 rupees on the sale of the investments out of the sinking fund investment account, and there we are transferring that into the bank account. And after having done all that, we realized that we have made a loss on the sale, total loss on the sale of the assets of 26,000 rupees, and that we are crediting the sinking fund investment account with the loss on the sale of the assets and debiting the sinking fund account. Finally, in the illustration 6 of this question, as a continuation of this question, we are supposed to prepare the lease account and the depreciation account also. So for preparing the lease account, the first entry that we make is that we are buying the lease. So we are debiting the lease account because the lease is an asset, and the bank account we are crediting because we have made a payment of 10 lakh rupees for buying that lease. Now this amount is being carried forward, and thereafter it's being brought down next year, and again in the next year it is being brought down, and finally on March 31, 2016, we are crediting the lease account and debiting the sinking fund account with 10 lakh rupees because the lease is now over. As far as the depreciation account is concerned, in the first year, we are transferring 3,20,000 rupees from the profit and loss account and transferring it to the sinking fund account. Again, in the next year, an amount of 3,20,000 rupees is being transferred from profit and loss to the sinking fund account. And in the third year, an amount of 2,92,000 rupees, which was a balancing figure that was required to raise the lease amount of 10 lakh rupees, that is debited to the uh, depreciation account and credit it to the sinking fund account. Now we come to the next method of depreciation, and that is called the machine hour method. Now in this machine hour method, whenever it is practicable to keep a record of the actual running hours that the machine is doing, the depreciation can be calculated on the basis of the hours that the machine has worked. Because whatever hours the machine works, that much wear and tear, that much more wear and tear the machine will undergo. So the machine hour rate of depreciation can be calculated after estimating the total hours that the machine would work during its whole life. So this estimation has to be made here with how many hours the machine will work. And on the basis of this estimation, the depreciation rate for every machine hour that the machine is going to run can be calculated. However, it may have to be varied from time to time. It is not necessary that it will be the same every year. Because whenever economic and technological conditions are changing, the machine hour rate may change. Just to ensure that the amount provided for depreciation corresponds to that amount which is considered appropriate in the changed circumstances. Now we would observe that this method is only a very slight variation of the straight line method, because under the straight line method, depreciation is calculated every year, calculated on a per year basis in one go, because there also we are estimating the useful life in years. Here we are estimating the useful life in number of hours that the machine would work. So that being the only difference, there is only a slight variation from the straight line method as compared to the machine hour method. Now, Schedule 2 is there in the Companies Act 2013, and that Schedule 2 prescribes what is the estimated useful life of different kind of assets for companies. And it also recognizes this method to some extent, the machine hour method. So therefore, the Schedule 2 of Companies Act 2013 has given this method a degree of credibility. Now this prescribes that the depreciation should be charged using estimated useful lives listed in it in the Schedule 2. However, in certain category of plant and machinery, it prescribes a charge of higher amount of depreciation if those assets are used for 2 shifts or for 3 shifts. In a way, Schedule 2 combines the straight line method and the machine hour method. So Schedule 2 makes use of both the methods and combines them together. Now let us take an illustration of this. There was a machine which was purchased for rupees 30 lakhs, and it was estimated that this machine would work for 24,000 hours. The scrap value at the end of the useful working life of that machine was expected to be 2 lakh rupees. That after the useful life, when the machine is sold, it would fetch 2 lakh rupees. And we anticipated that the distribution of the effective hours would be like this, that for the first 3 years, every year 3,000 hours the machine would be used. And thereafter, from the 4th to the 6th year, next 3 years, that means the machine would be able to work for 2,600 hours per year. And from 7th to 10th year, this machine would be able to work for 1,800 hours per year. Now we have to calculate the annual depreciation under the machine hour rate method. So how do we calculate the depreciation under machine hours rate method? First of all, we'll calculate for the first 3 years when we are estimating that this machine would work every year for 3,000 hours. So 3,000 divided by 24,000, because the entire working life, in the entire working life, it would work for 24,000 hours. So for the first 3 years, every year the depreciation amount should be equal to 3,000 upon 24,000 into, multiplied by the total amount for which the machine was purchased minus the scrap value. So 30 lakh minus 2 lakh is the 28 lakh amount. 28 lakh amount will be proportioned in the ratio of 3,000 upon 24,000. So 1:8 ratio. And this would mean an yearly depreciation of rupees 3,50,000 rupees. Similarly, for the 4th to 6th year, we'll use a value of 2,600 upon 24,000 into the 28 lakhs. So that comes to 3,03,33. And from the 7th to the 10th year, we'll use a figure of 1,800 because the machine is expected to work for 1,800 hours every year. So out of the total 24,000 hours in the entire useful life of the machine, so therefore we use a fraction of 1,800 upon 24,000 of 28 lakhs, which is 2,10,000 rupees per year. So this is how the depreciation will be calculated in the machine hour rate method. Now we come to the next method of depreciation accounting, which is called the production units method. Now under this method, the depreciation of the asset is determined by comparing the annual production with the estimated production. And then we use the formula that depreciation for any year will be equal to the depreciable amount into production during the period upon estimated total production. So here what we are seeing is not the number of hours the machine is working, but we are seeing that the amount of production the machine is doing. If during the entire time of the machine it will do, let us say, the total production, then we take the amount produced during one particular year and we divide the two, like amount produced during 1 year upon the estimated total production, and we multiply that with the depreciable amount. And depreciable amount is the total cost minus the scrap value. And therefore this method is applicable to machines which are producing product to uniform specification. Every product is having the same specification and uniform specifications. There this method can be applicable, because in this method whether the machine is actually working is not that important. How much it is producing, that is more important. That is perhaps more rational also, but it can be used only where the machine is producing product of uniform specifications. We'll take an illustration of this. Let's say a machine is purchased for 20 lakh rupees, and let us say that its useful life is 10 years, and finally it will be sold for scrap for 2 lakh rupees. So its residual value, so to say, is 2 lakh rupees. Now this machine is expected to produce in all 1.5 lakh units of the product during its entire lifetime. And the expected distribution pattern is that for the first 3 years it is likely to produce 20,000 units per year of the product. From the 4th to 7th year, it is likely to produce 15,000 units per year of the product. And from the 8th to the 10th year, every year 10,000 units per year. As you can see, the machine is losing its capacity to produce that much as we proceed forward in time. Now we have to determine the value of depreciation for each year by using the product units method. So product units method means the total units that it will produce, it is likely to produce is 1,50,000. It is producing only 20,000 rupees, 20,000 units for the first 3 years. So in the first 3 years, we'll be using a value of 20,000 divided by 1,50,000 into the depreciable value, and depreciable value is the cost minus salvage value or the residual value or the scrap value. So the depreciable value is 18 lakh rupees, and we are taking a fraction of 20,000 upon 1,50,000 of that. So for the first 3 years, every year the depreciation would be 2,40,000 rupees. For the next 3 years, the expected production is 15,000. So 15,000 upon 1,50,000, that gives us a 1 upon 10 ratio out of the 18 lakh rupees depreciation value. So that gives us a 1,80,000 rupees annual depreciation from 4th to 7th year, and then from 8th to 10th year we are taking a unit production of 10,000 rupees. So 10,000 upon 1,50,000 rupees gives us a 1 upon 15 ratio of 18 lakh rupees depreciable value, which is equal to 1,20,000 rupees of depreciation every year. Thereafter, we move to the next method, which is called the depletion method of depreciation accounting. Now, this depletion method is used in the case of mines, quarries, etc., which are containing only a certain quantity of the product, which means that the mine has a fixed quantity of the product, and it can be estimated that, well, this mine has so much of the total product. The depreciation rate will be calculated by dividing the cost of the asset by the estimated quantity of the product likely to be available. Now, annual depreciation will be the quantity extracted multiplied by the rate per unit. So, an example of this can be taken to understand how to calculate the depreciation by the depletion method. Now, this is called illustration 9. Messer Surya, they took a lease of a quarry on 1/1/2013 for 1 crore rupees. So this is a lease of a quarry or a mine for 1 crore rupees. As per the technical estimate, the total quantity of the mineral deposit, the technical estimate was made. It was found that the mineral deposit is likely to be 2 lakh tons. Depreciation was charged on the basis of depletion method. Extraction pattern of the mineral is that for the first year, 2,000 tons would be extracted. In the next year, 2014, 10,000 tons would be extracted. In the third year, 15,000 tons would be extracted. So extraction is going up as we are moving forward, because initially the extraction is lesser. As we go deeper, the extraction would be more and more. So based on the extraction, we have to show the quarry lease account and the depreciation account for each year from 2013 to 15. So when we say quarry lease account, it means that we are crediting the bank account, debiting the quarry lease account by buying this lease of 1 crore rupees. So we buy this lease of 1 crore rupees in the first year, then we have to allow the depreciation for the first year. So to allow the depreciation for first year, we realize that out of 2 lakh tons of the mineral that would be produced total, in the first year it is producing 2,000 rupees, 2,000 only, 2,000 tons only. So 2,000 out of 2 lakh gives us a fraction 2,000 upon 2 lakh of the 1 crore. So 1 crore is the total amount that was invested, and out of that 1 lakh, 1 crore, we are taking a depreciation at the rate of 2,000 upon 2 lakh, the 2,000 being the amount extracted in the first year, 2 lakh being the total amount that is estimated to be extracted. This gives us a value of 1 lakh rupees depreciation, and after allowing that, we are remaining with 99 lakh rupees. This 99 lakh rupees carried forward to the next year. Now, with this 99 lakh rupees, we are again calculating a depreciation for the next year. In the next year, of course, the extraction is 10,000. So 10,000 upon 2 lakh gives us a figure of 1 upon 20 of 1 crore, which is 5 lakh rupees. So next year depreciation is 5 lakh rupees, and we allow depreciation 5 lakh rupees. We are left with 94 lakh. Then for the next year again, the depreciation would be 15,000 tons upon 2 lakh tons. So upon 15 upon 200 is the ratio into the figure of 1 crore rupees again. That is 7,50,000 rupees. So total amount of depreciation for the third year is 7,50,000 rupees. We allow that, and we are remaining with 86,50,000 rupees. So that's how we have calculated we have made this depreciation account on the basis of the method which is called the depletion method, which is normally used for the mines. Now we come to the next topic in this, and that is called the profit or loss on the sale or disposal of the property, plant or equipment. Now, whenever any depreciable asset is sold during the year, we are depreciating an asset continuously, but it may sometimes happen that during the year we sell off an asset. So in that case, depreciation will be charged on it for the period it was used in that sale year. So a proportionate amount of depreciation will be charged. The written down value after charging that depreciation is used for calculating the profit or loss on the sale of that asset. We are calculating the written down value after allowing the depreciation for that year. And once we get that written down value, we use that to calculate the profit made or sale made on the sale of that asset. Whatever resulting profit or sale is made on the sale of the asset is ultimately going to be transferred to the profit and loss account. Example being, let's say the book value of an asset as on 1st Jan. Book value means the depreciated value. Let's say the book value of the asset as on 1st January 2015 is 50 lakh rupees. On 1st January 2015, the book value of the asset is 50 lakh rupees. We charge a depreciation at the rate of 10% on the asset. Now on 1st July, the asset is sold for 32 lakh rupees. In such a situation, what is the profit or loss on the sale? So to calculate that, first thing that we do is we take the book value as on 1st January 2015. Then we allow a depreciation for 6 months because here the asset is being sold for 32 lakh rupees and on 1st July. So therefore, the depreciation will be allowed only for half the year, which is 6 months, at the rate of 10%, and that is 2,50,000 rupees, because 10% for the entire year would be 5 lakh. So for half the year, it should be 2,50,000 rupees. And after reducing the depreciation of 2,50,000 rupees, we are left with the written down value as on 1st July of 47,50,000 rupees. The sale proceeds that we are getting is 32 lakh rupees from this. So we are going to lose here because we have a written down value of 47,50,000 rupees, but the asset is being sold for 32 lakh rupees. Therefore, thereby a loss on the sale of 50,50,000 rupees is happening here. Let's take one more illustration. A firm purchased on 1st January 2015 certain machinery for 5,82,000 rupees, and it spent 18,000 rupees on its erection or installation, which means that purchase price was 5,82,000 rupees and installation charges were, or the erection charges were 18,000 rupees. So total we can say 6 lakh rupees is the cost. Now, after this 1st January, July 1, 2015 arrives, and on July 1, 2015, another machinery for 2 lakh was acquired. On 1st July 2016, the machinery purchased on 1st January, having become obsolete, was auctioned off for 3,86,000 rupees. So this machinery which we had purchased for 6 lakh rupees, became obsolete. It was auctioned for 3,86,000 rupees, and on the same date, a fresh machinery was purchased at a cost of 4 lakh rupees. Now, depreciation was provided for annually on 31st December at the rate of 10% per annum on the written down value. So we have to prepare a machinery account. So therefore, we need to calculate the depreciation for every year. So first thing first, we start with the machinery account, and we find that we are buying 5,82,000 worth of machinery, for which we are debiting the machinery account for 5,82,000 rupees and debiting the and crediting the bank account, because money is being paid out of the bank, and thereafter we are again debiting the machinery account with 18,000 rupees erection charges, because that is also capital expenditure, and then we have to allow a depreciation here. So depreciation is being allowed at the rate of 10%. So machinery is 6 lakh rupees, and thereafter on July 1, an amount of 2 lakh, another new machinery was acquired. So here, this new machinery of 2 lakh is acquired on July 1, so only a 6 months depreciation will be allowed here. 1 year depreciation is 20,000, so 10,000 will be depreciation on this new machinery which was purchased on July 1. But on the machinery which was purchased on January 1, 10% depreciation would be allowed there, so 60,000, because on 6 lakh, 60,000 would be the depreciation, and on 2 lakh rupees for 6 months, 10,000 depreciation. So in all, a total of 70,000 depreciation will be allowed here, and after allowing the depreciation, the amount carried down will be 7,30,000 rupees. Now, having done that, this amount of 7,30,000 rupees will be brought forward to the next year on 1st of January 2016. Thereafter, we have to allow a depreciation on the sold machine, because on January 1, 2016, on 1st July 2016, the machinery which was purchased on 1st January was auctioned for 3,86,000 rupees. So on 1st January, the machine which was purchased was auctioned for 3,86,000 rupees. So since it was auctioned for on 1st July itself, it means that half year depreciation would be given on this. So therefore, this machinery was 6 lakh rupees, and on 6 lakh a depreciation was given of 60,000 rupees. So what we can say is the written down value on this particular machine was 6 lakh minus 60,000, which comes to 5,40,000. So on 5,40,000, half year's depreciation comes to 27,000 rupees. So this half year's depreciation is being allowed at 27,000 rupees, and then this machinery was sold off for 3,86,000 rupees. So we are crediting the machinery account with this 3,86,000 rupees and debiting the bank account, because the amount that we have got here is 3,86,000 rupees on the sale of this machine. Now, having sold this machine, we are saying that out of 5,40,000, 27,000 we have given depreciation. The remaining WDV is 5,13,000, and we have sold this for 3,86,000 rupees. So there is a profit of 1,27,000 rupees. There is a loss on the sale of this machine of 1,27,000 rupees, because to calculate the loss, we have found out the WDV as on the rate of the sale, and then reduce that from the sale proceeds. because sale proceeds are less than the written down value, we are incurring a loss of 1,27,000 rupees here. Now this 1,27,000 rupees loss is being adjusted into the profit and loss account, because it is straight away going to the profit and loss account by crediting the machinery account and debiting the profit and loss account with 1,27,000 rupees. When we debit the profit and loss account straight away with this entry, and then we allow a depreciation of 39,000 in this case, because now we are having this particular machinery is gone, and on the second machinery that we purchased for 2 lakh rupees, there was a WDV of 1,90,000 rupees, and we allow a depreciation of 19,000 rupees. As 10% depreciation, we get a WDV of 1,71,000 rupees on the machinery 2. And the fresh machinery was purchased at a cost of 4 lakh rupees on the same day, which means that on 1st of January, on 1st July, machinery was purchased for 4 lakh rupees, and therefore for this year, since it was purchased for 4 lakh rupees, half year depreciation would be allowed. So half year depreciation, full year depreciation would be 40,000 rupees at the rate of 10%. So half year depreciation would be 20,000 rupees. We are allowing a depreciation half year 20,000 rupees on this 4 lakh machine, and finally we get a WDV of 3,80,000 rupees here. But this machine was purchased for 4 lakh rupees, and finally depreciation of 20,000 rupees is being allowed for 2016, as this machine is purchased only in the year 2016. So finally, on the amount which is remaining, the depreciation for the year 2016 is calculated at 39,000 rupees, and after having allowed this depreciation of 39,000 rupees on the sale of on the remaining amount of the machine, because here the depreciation of 19,000 plus 20,000, so 20,000 is the depreciation on the third machine, 19,000 is the depreciation on the second machine in 2016. A total amount of 39,000 of the depreciation has been provided here, and the depreciation on the sold machine of 27,000 rupees has been separately provided, which is mentioned here, 27,000 rupees. So total depreciation of 27,000 rupees on the sold machine and 39,000 rupees on the other two machines is being provided here, and therefore a remaining amount of balance called 5,50,000 rupees is going to be carried forward to the next year. So this is how depreciation is calculated and allowed. In the case of in this case and method where depreciation is being allowed at the rate of 10% on the written down value. So here the written down value method has been used to calculate depreciation, but the new machineries are being acquired and sold off, and therefore we have to calculate the depreciation carefully in such cases. Now, having completed depreciation accounting up to this level, we will be moving towards change in the method of depreciation. How do we account for situations where we have to change the method of depreciation? We'll try to learn that in the next part of the lecture that we will be delivering tomorrow morning at 8 a.m. So be with us, please, at 7:45 a.m. for the next part of the lecture on depreciation accounting. We are doing very interesting analysis of depreciation. And though all these methods may not be in your syllabus, but it helps you to understand the depreciation as a concept and how depreciation is allowed in various different situations and stages. So therefore, it helps us to understand depreciation completely and fully. And therefore, with those words, I come to an end of today's webinar, having covered quite a deal of ground in depreciation accounting, but much more is remaining. So please join us surely at 7:45 a.m. tomorrow morning for the next session. Thank you so much for having been with us with a lot of patience.